Wall Street near record highs as investors await jobs report and Fed rate cuts. An in-depth 3,000-word analysis on the state of U.S. markets, the Federal Reserve's role, and the implications for investors and households. Introduction: A market at a crossroads. As of August 30th, 2025, Wall Street sits just beneath record highs. The S&P 500, a broad measure of the U.S. equity market, has been powered by strong corporate earnings and enthusiasm for technological innovation, particularly in artificial intelligence and semiconductor industries. The Nasdaq Composite continues to reflect investor faith in the digital economy, while the Dow Jones Industrial Average has remained resilient, supported by industrials and consumer companies. Yet, beneath the optimism lies a critical inflection point. Investors are looking toward the August jobs report, due next week, as a decisive piece of evidence that could shape the Federal Reserve's next move on interest rates. Markets are already pricing in a significant probability of a rate cut later this year. If that expectation proves correct, it could mark a turning point after years of monetary tightening that began in the early 2020s. Section 1. Wall Street's resilient rally. The U.S. stock market's rise to near-record levels is not an isolated phenomenon. It is the culmination of several overlapping forces. 1.1. Corporate earnings and innovation. Strong earnings across sectors, particularly in technology, consumer discretionary, and energy, have provided the fundamental justification for the rally. Artificial intelligence, which has dominated corporate strategies, has continued to generate optimism. Semiconductor giants, cloud providers, and software innovators report robust growth. 1.2. Investor sentiment and liquidity. Investor psychology plays a crucial role. After a decade of volatile cycles, from the pandemic crash of 2020 to inflation-driven sell-offs of 2022, today's markets reflect cautious optimism. Liquidity remains abundant, partly due to the Fed's pause on further rate hikes and expectations of easing. Institutional investors, such as pension funds and asset managers, are allocating more capital to equities in anticipation of a supportive policy environment. 1.3. International comparisons. U.S. equities also remain attractive relative to global markets. While Europe struggles with sluggish growth and Asia faces a mixed outlook, Wall Street benefits from the resilience of the American consumer and a steady pipeline of corporate innovation. Section 2. The Federal Reserve's Balancing Act. The Federal Reserve, as the central bank of the United States, sits at the heart of this story. 2.1. A decade of policy shifts, 2020-2021. Ultra-loose policy to counter the pandemic. 2022-2023. Aggressive tightening to combat multi-decade high inflation. 2024. A cautious slowdown in hikes, with inflation gradually easing. 2025. A wait-and-see stance with the Fed signaling data dependence. 2.2. The inflation story. Inflation, once the Fed's primary challenge, has receded from peaks above 9% in 2022 to closer to 3% today. But the decline has not been linear. Supply chains, energy markets, and wage pressures all continue to pose risks. 2.3. Rate cuts in sight. Section 3. Why the jobs report matters. The U.S. monthly employment report has always been a market mover, but its importance is magnified in 2025. 3.1. A measure of labor market health. The report includes non-farm payrolls, unemployment rate, and wage growth. Together, these indicators paint a picture of the economy's vitality. 3.2. Wage growth and inflation links. High wage growth can fuel inflation as businesses pass on labor costs to consumers. Conversely, moderating wage growth signals that inflationary pressures may be easing. 3.3. Investor anticipation. Traders in equities, bonds, and currencies are all holding positions lightly ahead of the data. A strong report could delay rate cuts. A weak one could accelerate them. Section 4. Market mechanics, stocks, bonds, and the dollar. 4.1. Equities. If the Fed cuts rates, equities benefit. Lower borrowing costs reduce corporate financing expenses and make stocks more attractive relative to bonds. 4.2. Bonds. Treasury yields have been stable, but expectations of cuts could push yields lower. 4.3. The U.S. dollar. A dovish Fed weakens the dollar. While this hurts U.S. importers, it benefits exporters and multinational corporations by making American goods more competitive abroad. Section 5. Broader economic implications. 5.1. Consumers. Lower rates would ease borrowing costs on mortgages, credit cards, and auto loans. For households, this could provide relief after years of high rates. 5.2 businesses. Corporate America, particularly in capital-intensive sectors like manufacturing and infrastructure, would benefit from cheaper financing. Small businesses, too, would find credit more accessible. 5.3 risks of overstimulation. However, if the Fed cuts prematurely, inflation could reaccelerate. Section 6. Investor Psychology and Possible Scenarios. 6.1 Bullish Scenario. Jobs report shows moderate cooling. Fed signals rate cut in late 2025. Stocks break new highs, with tech leading the rally. 6.2 Bearish Scenario. Jobs report shows strong growth and rising wages. Fed delays cuts into 2026. 6.3 Neutral Scenario. Jobs report mixed. Fed holds steady. Markets tread water, waiting for further clarity. Section 7. Everyday Impacts. 7.1 Housing market mortgage rates, currently elevated, could fall if the Fed cuts. This would spur demand in the housing sector, potentially reigniting home price growth. 7.2 Retirement accounts. 7.3 Savings accounts. On the flip side, savers have enjoyed higher yields on deposits. Rate cuts could reduce these returns. Section 8. Global Ripple Effects. 8.1 Emerging Markets. A weaker dollar could ease debt burdens for countries that borrow in dollars. 8.2 Global Trade. 8.3 Currency realignments. As the dollar weakens, currencies like the euro, yen, and yuan could strengthen, reshaping trade flows. Section 9. Lessons from History. 1990s. Fed rate cuts helped sustain a tech boom. 2008. Cuts and quantitative easing stabilized markets post-crisis. 2019. Pre-pandemic cuts fueled a late-cycle rally. Today's situation is different, but rhymes with history. The Fed is balancing inflation control with growth support. Section 10. Looking ahead. The coming months will test investor resolve. The jobs report, inflation data, and Fed communications will determine whether Wall Street breaks decisively into new record territory or retreats in disappointment. What remains certain is that the Federal Reserve's actions will echo across markets, households, and the global economy.